And if we take a look at this page here, this is going to give us more information about VOO, or the Vanguard S&P 500 ETF, which is going to replicate the S&P 500, which is what I just showed you in that previous example. So this is a very popular method for those who are looking to follow that exact strategy that I just showed you. The expense ratio comes in at 0.03%, and the dividend yield over the last 30 days is 1.23%. If we scroll down, we can get more information here. For example, it mentions here that this index represents the 500 largest publicly traded US companies, and it is considered to be a gauge of the overall US stock returns, as the S&P 500 is the most popular benchmark. In terms of the risk-reward scale, this comes in at a 4 out of 5, so it is going to be a bit more risky than some other investments out there, and that's because you have 100% allocation into equities or stocks. That's going to carry more risk than bonds, for example, which are going to have less downside potential, but also less upside potential. Further down, we can get more information about the performance over time, as well as the fees, and you can see here how the returns have compared to the benchmark here of the S&P 500. So for example, over the last year, VOO has returned 36.32%. Meanwhile, the benchmark, or the S&P 500, has returned 36.35%. So there's a very slight difference there, but for the most part, it is replicating the performance of the S&P 500 as closely as possible. Taking a look at the details over here, it mentions, for example, the total amount invested in this fund as of the end of August is 1.2 trillion, which is wild, just how much money is parked right here in VOO. And over here on the right, this style box is also helpful for understanding what you're actually investing in. At the top, it's going to show you whether you are making a value investment or growth here, which is where companies are trading more so based on their future earnings potential and growing at a faster rate than the average of the market. This is going to be a blended strategy, so it fits right here in the middle, meaning that you have a mix of both value investments and growth investments in this ETF, and it also shows you the size of the companies you're investing in. So in this case, since you're investing in just the top 500, it's mostly going to be large cap or large size companies that you are investing in. If we take a look at this pie chart here, this is going to show you what percentage of your money goes into different sectors. For example, here, if we look at what's going to be the largest component, that's going to be information technologies, making up 31.1%. The next largest category here is going to be financials at 13.2%, followed by healthcare at 12.2%, and so forth. And based on whatever companies are the most valuable in today's economy, that is going to change these allocations in terms of what percentage of your money goes into these particular segments of the US economy. And if you're curious about the largest holdings in that, down here, this is going to show you what individual stocks make up the largest portion of the fund. In this case, about 7% or 6.97% of the entire fund goes right into Apple stock. Then you have Microsoft making up 6.5%, Nvidia at 6.2%, and then you also have Amazon, Meta, the parent company of Google, Berkshire Hathaway, Eli Lilly, and Broadcom making up a large portion of the entire portfolio. So when you invest in VOO, or the S&P 500, through other providers, a large portion of your money goes right into these stocks. And if we take a look here at the top 3 holdings alone, almost 19% of your money goes right into Apple, Microsoft, and Nvidia alone. Further down, we can get details here about the distributions or dividends, as many of the companies held within that portfolio pay dividends. So what happens is all of those dividends are collectively held onto and then paid out on a quarterly basis. So in this case here, it is a quarterly dividend payment, and you can get details here about the previous dividends and then future upcoming dividend payments from the fund. And of course, if you want to maximize your return potential, you'll want to reinvest those dividends back into the ETF, allowing you to own more shares and earn more dividends in the future. You can also down below get more information about the fund managers who are actually picking and choosing the investments, which are, as we said, replicating the S&P 500 as closely as possible. This is going to be a passive style of management, so there is a lot less human involvement, but this is where that 0.03% expense ratio goes towards, is paying these fund managers to allocate the portfolio accordingly.